the amount, what happens then? Why are we making a provision? If I have to definitely spend the money, I have to provide it. If I am failing to provide, what will happen? What is the consequence? The consequence I can explain, that's all. Nothing else is provided in this.
No, that's right. This is spending. So once I'm not spent, you shouldn't have come provision on it.
No, that's what I'm saying. You don't have to make a provision if there is a clarity in your mind at the management level that you are not going to spend money this year. You have brought the question, and instead comes the process of formulating CSR policy, making CSR committee, nothing is happening still. The next 6 months they are going to do all this, policy is not yet made, team is not selected, nothing is happening, therefore prospects of spending is not there. If there is no prospect of spending, will it be, as Yedbhai said in another question, what are the consequences of not spending? Consequences of spending, not spending, let us say director is into a jail. Then better take a provision and say, demonstrate to the world that you have got intention to spend the money. In this case, it's not so. What it says is that if you are not able to spend money, only explain it. That's what exactly it is saying. Therefore, there is a possibility that you may not spend. If you are not likely to spend, don't make a provision. If there is a possibility that you are going to spend, make a provision. That's all. A completely prudential practice. Yeah.
Is it not a statutory obligation to make a provision because anyway you are supposed to spend either this year or next year?
I am reading this provision. I am making this point here. If the company fails to spend such amount, the board shall in its report under clause O of subsection 3 of section 134 specify the reasons for not spending the amount. So there is no certainty that you will spend. When do you make a provision? When there is adequate certainty of that particular event to happen, then you will make a provision and to make the accounts true and fair. Here, there is a very clear provision available to you that you can avoid spending the money or you may not be able to spend the money. If you are not able to spend the money, the directors as a part of the responsibility have to tell the world that I am not able to spend the money. And there should be sufficient reasons for it. General body will question them, ministry will question them, so many people will question them, and therefore to be able to make a statement that I am not able to spend money is not that easy. It is a director's responsibility, people will be questioned. And in performance evaluation directors also it will come. You are not able to spend 2% of money also it will come. So the board of directors understand all this. So there is no provision which says, let us say in 2014-15 I have not spent 2%, I have to carry forward unspent money to next year. There is no such provision at all. So clearly speaking, if you are not able to spend the money, you have to explain and therefore you may not have to spend. But there is a clarity that there is a roadmap that you are going to spend the money in the next 6 months, though first 6 months you have not spent, make a provision. That's all I am saying. The next question is, XYZ is situated in a backward area. The company has constructed the roads near outside the factory area to provide access to the approach to factory. Company has constructed other roads around the village, such as station road, roads connecting village to highway, etc. The company has also constructed public garden and has laid equipment which is used for exercise regime, building stamina, etc. The company draws attention to provisions of section 135 which state that CSR preference should be given to local areas and also to rules which say that activity carried in ordinary course of business will not qualify as CSR. In the light of this, whether expenses listed 1, 2, and 3 above will qualify as CSR expenses. For question number 1, reply is very clearly no, because as the question itself says, it's ordinary course of business only to improve your access you have done it. Therefore, question number 1 is not CSR. Question number 2, it may qualify as a CSR expenditure, provided it's a rural in that sense of the term. If you, what is a rural? I don't think there is clarity there, but it's a rural area. Question number 2, expenditure will always be allowed. There's no problem in that. And then third one is slightly a grey area, because if you look at the schedule of events which CSR is allowed, preventive healthcare is one such entry allowed in the schedule. So will you consider the gym equipment etc. you put in the public garden accessible to all will be considered as a preventive healthcare? It has to be tested. If it can be demonstrated that it's going to be preventive healthcare matter, probably you can try to avail the expenditure. But if you are only giving to those give some swings and seesaws, probably it will not come in. But if you provide a full-fledged gym, probably you can try to claim the expenses.
We are on page 81 now, question number 27. 27 and 28 raise broadly similar question, but I will leave it 27 first. As you know that those companies, certain companies are only required to go for rotation of auditors. They are connected with the paid-up capital. And in this particular case, it has been stated that because it was having a paid-up capital of 20 crores, as on 1st April 2014, it was required to rotate with the auditor because the auditor had already completed its 10 years of its tenure. So the proviso says that transition period is given, and during this transition period of 3 years, you are supposed to comply with the provisions. Now what happens is that during this 3 years, the question says is that the company reduced its share capital, let's say by buyback option. So it is now reduced to 15 crores and therefore below the required limit. Now the question is the company still required to go for rotation of auditors? Or is it that whatever was there as on 1st April 2014, it is frozen? Now if you read the section, it is possible to interpret it two ways. Is that in one way is to look at it that the particular situation was frozen. So situation as on 1st April that you see, was the auditor had he completed more than 10 years? The answer says yes. Then did the company have the required minimum paid-up capital? The answer is still yes. Therefore, for 14-15 years, the situation was that you were required to comply, and then you were given a 3 years. Now the question is, in the next year the capital has gone down, or within the transition period has gone down before the end of that particular period. I think if you read section 139, 132, what it talks of is that, see, if you read it, it's not that the situation is frozen. Every year you have to read this section and check whether the compliance is required of that particular section or not. So you will check two things. Has your auditor having more than 10 years? Again, the answer will obviously be yes, he is having more than 10 years. In fact, his tenure is increased. Did he have the capital? And that condition also has to check during the whole transition period. Every time before you appoint the new auditor. In that particular case, when you see the condition is not complied with. So even if it was in the 3rd year of transition period, just before the auditor's last appointment, if the share capital had reduced and it had gone down below that limit, then according to me, the provisions of this section should not apply, and therefore the auditor can continue unless of course the capital is reduced or whatever. Then the next question is the other way around. The capital was already 15 crores as on 1st April 2014. So at that particular situation, although the tenure was more than 10 years, that particular section 139(2) did not apply. But during this transition period, let's say within 6 months after the first appointment, the capital was raised to 20 crores. Now the particular auditor has already completed 10 years. In the next year, first of all, does this section apply to such a company, number one? If it applies, then is the transition period available if during this transition period the share capital has increased? So that is an interesting question. I think the way I look at it is that, as I said in the earlier case, 139(2) you have to check every year. But if you read the proviso, which gives you a transition period, it says that you are supposed to comply with the requirements within these 3 years. Now, what are the requirements? Does it necessarily mean only rotation of auditors? In this particular situation, look at the situation is that the auditor is required to be appointed now, is required to be rotated. But the 3 years period was given to them by way of transition. It's a one-time transition period is given as a relaxation. So therefore, the relaxation has to be interpreted liberally. And the wording used, which are there, is that you should comply with. Now, so long as you comply with those provisions within that 3 years, then I think, so in short, if your capital has increased, you do get this 3 years transition period to complete the thing. So suppose you have 2 more years, let that auditor continue, and then complete. Now this is somewhere where I am maybe stretching a little and seeking a liberal interpretation, but it's a relaxation. It is a one time, this totally new law has come, and you have to do a lot of things. So if 3 year transition has been given for existing companies, why not give a company for who has slightly increased the share capital and just come into the condition? So I will answer say that yes, you get the full transition period.
This is again very interesting. The company engaged in manufacturing nutrition products gives free coupons to the specifically identified NGOs to be distributed to schools of slum and rural areas. Upon production such coupons as designated places in some specific stores, the students can purchase nutrition products of the company free of cost. The questions are: will such an activity qualify as CSR or is considered ordinary course of company's business? If considered as a CSR, can the company recognize the sale upon collection of coupons given purchases to the specified stores with corresponding debit to CSR expenses? I think its question is, the question that is raised is, I am manufacturing nutritious products and I am giving this to some people. Is it ordinary course of business? The point here is that I earn money, I give money for CSR activity. Is it qualifying? It is qualified. And you are giving away product instead of your money. That's what you are trying to do here. Therefore, the expenditure debits to your revenue by giving away products is acceptable as CSR. There is no question and doubt about it. But the issue is, what is the basis on which you are doing it? Is it given to generally uncontrolled number of persons through any other agency like NGO, or are you trying to experiment the quality of your product in a particular village? Let us say I adapt this village, give nutrition product. After 4 years, I write a report saying that we are supplied for 4 years in this area, and all the youngsters are now very well needed. The nutrition levels have gone up. If there is a report you are going to give, it's a matter of advertisement. It's an ordinary course of business. But then, if you are trying to say, I give it to NGO, NGO will control and decide as to whom should give this product to, and there's no company has no control whatsoever at all on the ultimate beneficiary of the nutrition product. Probably it can come as a CSR activity. I don't know whether we should take such kind of a accountant view of this kind of activities. Hopefully the companies will try to open up their hearts. But anyway they want to spend money, let them spend with generosity instead of trying to make them tricks around it. That's what I think we should suggest these companies. So what I'm saying is, if it is control of the ultimate beneficiaries is not with the company, it is going to be given free away. It's not an experimentation for the purpose of future reports to be written, etc. Then it can qualify as CSR activity. Mere fact that the nutrition product can be collected by giving a coupon will not take away the character of the scheme. Why am I saying this? For example, this nutrition product, whatever is there, has to be stored under certain particular conditions, let us say, temperature or whatever. That has to be given through, without getting faked, it has to be given through some credible stores. In that case, this coupon may be a good idea of saying that. NGO will go and give coupon and person will come and collect the commodity. And then we may want to stock it in so places, reliable, etc. So the process of giving a coupon will not take away the character of CSR, but intent will definitely hurt it. Intent, if it's not experimentation, intent is not advertisement, intent is genuinely given for the purpose of providing nutrition to some people generously, then it's fine, it can qualify as a CSR activity. Under miscellaneous questions, there are one question to me. A private limited company wanted to issue ESOPs to his employees. Private limited company wanted to issue ESOPs, okay, they didn't issue. Is this required compliance at 42 under section 62 of the Act along with rules? How company will comply with the requirements of 42, etc. 62 1B is attracted and not section 42 in this case very clearly. 62 1B talks about ESOPs. There is no bar on a private limited company giving ESOPs to the client, to employees. There is no bar on that. What it requires is it requires a special resolution to be passed. It's only attracting 62 1B and not 42 at all. Therefore, the first question related to 42 does not arise. Second question doesn't arise. You can give ESOPs to your employees. Only thing is, how do we try to give benefit of this ESOPs to the company is a question that we have to understand. Then you have to form a trust which will take the shares away, or company has to buy back the shares to provide the benefit to the employee of appreciation. So a different matter. Whether ESOPs can work in private limited company is a bigger question. But theoretically speaking, in this case, only 62 is attracted and not 40. I'll take the question. Now. Okay, this is a question. This particular question says, as on March 31st, 2024, there are so many events which are say commercial paper loan 30 crores, loan from women's self-help group something, share application money, debenture issued by mortgage properties, optionally converted to debentures, loan from A. there are so many items. Let me go to the item by item now. What the question says is, what are the various complications arising out of the new act because of this particular financial stature of the particular company is the question to me. To the best of my understanding of this issue, definition of the deposit is very broad, and therefore item 3, 8 and 9. Item 3, 8 and 9 would mean 3 is talking about share application money, 8 is about advances from customers, and 9 is retention money for 2 years for capex, etc. They all will get attracted under the definition of public deposits as of today. The only advantage is that they are all before the date of implementation, and therefore we can take a view that since they are all prior period information, what we call activities, that is prior to the implementation of the act, we can take a liberal view here saying that they don't attract public deposit rules as of now. That's what we can say. But similar transactions doing now onwards will have a difficult situation. But in this case, the point that the saving grace in this case is the company is already accepting public deposits. Therefore, we expect that the company is in compliance with the other public deposit related rules, including limits, etc. And therefore, even these three are attracting public deposit rules, the company is not in any great difficulty because they are already complying with the requirements there. But if they had no public deposits at all earlier, then it's a different regime altogether. And then items 6 and 7 do not need any special treatment under RPT since they are past events. Again, I am taking a liberal view. 6 and 7 deal with transactions with related parties. Loan received from A, who is relative of director X. Loan received from Y, a shareholder of the company. But again, I am taking a view only because of the past period information. Item number 3, attract 40 to 6 about 60 days. Only saving grace is that it's such issue is not under the new act and one can try to use that argument. That is, if you look at 3, you are talking on January 1st. Yeah, I think JNY has already explained this in great detail earlier also. Since you are taken on January 1st, 60 days are already over before the commencement of the act. So therefore, you are in a safe zone. But had it been March, situation is overlapping up to April. Nevertheless, the contracting point is before the date of implementation of the act, we can take a liberal view. But going forward, it will be difficult. But I don't know why lawmakers have not envisaged situations like allotment pending FDI, allotment pending approvals in SEBI and all. They are not envisaged. Why? Either they are expecting the efficiency of the government machinery to go up, or I don't know what. But then there are important things that we have got to live with. Questions are to me about. Thank you.
Excuse me. On the first, on the earlier slide, the share application money is also from a non-resident. Even if it is considered as a deposit after crossing 60 days, can we take an exemption that it is from a non-resident and therefore not a deposit?
I don't think so. If source of deposit will not matter. It's a matter of purpose for which you have taken it.
So there are exclusions in the deposit definition that any money taken from a non-resident is not to be considered as a deposit.
I need to read it. I'm not sure.
I think you are right. As I said in the earlier case, that if you have taken a loan, let's say from a company, then it is excluded altogether. Then it is a share application money or not. The same principle would apply. Any money taken from a non-resident, there is specific exemption. And of course, we are talking of companies act only. There is a provisions are there for FAMA and all that, but that's a different situation. So, if you have taken money from non-resident, then it is not a deposit at all. So those provisions should not apply even after 2014. The question to me now next is question number 29 on page 82. Again, a very interesting question. As you know, auditors are now appointed for a term of 5 years. But so it's a balancing thing. That one thing is that the auditors should have comfort for 5 years that they will not pay more, they will not, so they have comfort of independence. At the same time, so as to not have totally no say whatsoever for shareholders, it is required that every year at the AGM, his appointment should be ratified. That is what the requirements of provision say. So what it has to be done is that every year, under section 139(1), the appointment of the auditor has to be ratified. So the question now is, what has happened is, the question which has been raised is that, let's say the shareholders do not ratify. So what will happen? Is it removal? Is it a casual vacancy? And how it should be dealt with? Now, first of all, just we all know this, but let me just again repeat what is the concept of ratification. Ratification is regularizing something which was irregular earlier. So if something was wrong earlier, like let's say there was something to be done by the board had the powers, but unfortunately managing director did it without taking the approval of the board. So he puts the matter before the board of directors. The board of directors says no problem, this was you have done in the interest of the company, we ratify that. So it is like making something regular which was possibly voidable. That is the definition of ratification. So in this, the word first of all ratification is wrong. But let's try to take up some positive meaning, saying that ratify, because this is important. Ratify means what? Either the word is you approve or you don't approve. Because based on that, the other question is up. Suppose you disagree. Suppose there are shareholders who come and say we don't want this auditor, and when the matter comes for appointment, they vote against it. That is not ratification or ratification. They have exercised their right to remove that particular auditor. But then the question comes: does it become removable? So let's come to that question later on. First is that is it in that particular case? So again, you have to understand what ratification involves. It means that the resolution would have been put before the shareholders, and it seems that the number of people who voted against it were more than the number of people who had voted for it. So that was kind of what happened. So now the question that has been raised is it removal? Now I don't think this is removal, although it may amount to removal by the shareholders, because removal is specifically defined as a particular procedure for that, and removal is something broader. Removal can be before the terms. Ratification is at the particular AGM. Suppose I don't like the auditor, as soon as I appointed within 2 months I don't like. Whatever the reason, the auditor is bad or I am bad, whatever reason I don't want. So I go for the procedure of removal, and that involves central government approval and special resolution and all that. So this cannot be equated to removal, so this is not removal according to me. Then let us look, what will be the consequences of this? Is it a casual vacancy? According to me, casual vacancy, we had a concept of casual vacancy here. What the Companies Act 2013 is referring to something different. Now I will come to the rules later on which equate something to this, but generally casual vacancy is something different than this. Now let us look at section 139(10) also. What it says is very interesting. That if no auditor has been appointed. See now, what happens is that you are placed, suppose this is our annual general meeting and the appointment of auditor Mr. X was put here, you people did not approve it. So it did not got ratified. In that case, what has happened is, nobody knew this was going to happen. So no other auditor was proposed. If somebody